We're looking at a major shift in DeFi. Yields that once reached double digits are now dropped below traditional benchmark, like US Treasuries. When users look at today's lower yields, what do you think they misunderstand most about why those early returns existed in the first place?
There's been obviously a lot of geopolitical uncertainty in various events without the demand to borrow against prime assets like Bitcoin and Ethereum, and without some of these yield-bearing stablecoins. It becomes a lot harder for money markets to generate yield for lenders, and without that, less liquidity will kind of come into the system.
Do you think the market is finally pricing risk correctly, or is there still a disconnect?
It's a good question. I would say...
Hi, I'm Dr. Lorena Nessi from CCN, and today I'm joined by Matt Fisher, CEO of Katana. We're looking at a major shift in DeFi. Yields that once reached double digits are now dropped below traditional benchmark, like US Treasuries. So that raises bigger questions about how those returns were generated, how risk was priced, and what kind of models can actually last. We're going to look at what happened, what's changing, and what's coming next. So thank you so much, Matt, for joining us today at CCN. Welcome.
Thanks for having me, Lorena.
So shall we start from the start? When users look at today's lower yields, what do you think they misunderstand most about why those early returns existed in the first place?
Yeah, so I think when people look at the yields today, they don't know if the risk reward is worth it for them. There's been obviously really high yields during bull markets, and when the market starts to shift and the sentiment shifts and the demand for leverage reduces, that definitely puts the downward spiral on yields. When you pair that with some of the exploits that have happened throughout DeFi's history and some earlier this year as well, that makes people think and reconsider whether the opportunity cost is worth it for them.
So what was happening? What has changed, you think?
Yeah, so I mean, I think there's been obviously a lot of geopolitical uncertainty in various events in recent times, I would say. And then additionally, that puts different structural and different pressures on different pricing and different investment strategies. Recently, Resolve had an exploit, which was one of the top yield-bearing stablecoins, and Drift also had another exploit in the Solana DeFi ecosystem as well. And what that kind of does is it forces investment funds and capital allocators to reevaluate the risk reward of the different opportunities. At the same time, that kind of lowers, in Resolve's case, it lowers the appetite to lend against those assets. And so if you're a lender and something like that defaults in DPEGs and goes to zero or whatever price it kind of goes to, that obviously has a pretty detrimental effect on your principal. And so, yeah, I think that's a few of the things as well. And without the demand to borrow against prime assets like Bitcoin and Ethereum, and without some of these yield-bearing stablecoins, it becomes a lot harder for money markets to generate yield for lenders. And without that, less liquidity will kind of come into the system.
And do you think token incentives or inflation had to do with it? Do you think it was more about growth or sustainability?
Yeah, I think crypto is kind of continuing to mature every year. And there's a lot of high in the sky valuations over the past few cycles. And a lot of the yield was driven by a lot of these token emissions. From a protocol's perspective, if everyone else is kind of doing it, it's pretty hard for someone to come check out your product if you're not and you're new. I would say kind of getting to that first 10 million, 20 million, 50 million, 100 million of TVL is something that kind of builds a lot of trust. But in order to get there, and in order for people to take that risk of a less battle-tested and new product, token emissions have been the force function to get people to come check it out. I think with how certain token prices performed and with how protocols that have kind of came and went, people have kind of sobered up to what have been the advertised yields. and are really looking at that. And then the other thing is as time goes by and more exploits happen, people are more they just feel safer and better taking lower yields, but also reducing like the risk while they're doing that.
In traditional finance, as we were saying, we were talking about risk. Higher returns usually mean higher risk. So in DeFi, that link is often unclear because it's just more difficult to evaluate it, right? So do you think the market is finally pricing risk correctly, or is there still a disconnect?
Yeah, it's a good question. I would say there are definitely people out there that are pricing risk correctly and are being more selective on where they put their capital. And then there are other ones that have not and are reminded as such when they're vulnerable to new exploits or anything around that. I think it's a work in progress, but we've seen a lot of more institutional demand for safer yields recently, and a lot of these kind of integrations, like Firebox just announced one today with Aave and Morpho. I think Aave and Morpho have been very battle tested over the years, and so people are pretty comfortable with that. For the newer protocols, that is a more complicated underwrite for capital allocators on the safety of that and what they should demand in terms of the yields. And that kind of goes back to the state of the market right now is if people are paying 20%, 50% originally to kind of bootstrap the liquidity, it's worth it for people. But right now, yields aren't like high enough to justify that for those people too.
Can you go a little bit more into what real yield actually means?
Yeah, for sure. So yield can come from a few different forms, especially in DeFi. I think there's two main ones. One is like the native yield and one is kind of this token emissions. In terms of the native kind of like base yield, it's driven from on-demand or on-chain economic kind of activity. So that can look like borrowers paying lenders is probably the simplest form of that. On the token emission side, which is where you kind of get to that 20% that is like advertised in DeFi, that comes from a lot of like the governance tokens of that protocol or of that chain supporting the yields there. And so back to like the point kind of started out with, which was the native yield just isn't there for some people right now because of those kind of structural things going on with like the market and the amount of borrower demand. I think one thing that DeFi needs to solve for right now is bringing a lot of borrowers kind of on chain and showing that the rates on chain are better than off chain. It is solving and there's a lot of integrations that have kind of continued to go live. Like Coinbase had this integration with Morpho that drove like $1 billion in TBL. There's a Firebox, and as I just mentioned today, there's Kraken and a bunch of different earn products. We had people like Ethereum digital asset treasury deploying on Katana. There's a bunch of supply liquidity that will come in, and that can scale if the yield is there, but it will hit a point where if there's no borrow demands to kind of follow up with it, then the yields just won't be as attractive as they are off chain with treasury bills and these other kind of things too.
And how can users measure that risk?
Yeah, so there are, I think this has been like a known gap for a while. There is not kind of like the same like Fannie Mae, like Freddie Mac kind of thing in the housing market to like evaluate risk, but there are people like Credora and other kind of agencies that want to try to like price risk. There's Blue Chip, which is like a stable coin risk evaluator on like the backing and what different kind of controls, whether that's security or the collateral it's backing, like the stable coin overall. There's also like risk curators, which has been like a popular segment of the market on Morpho and starting to be on Euler and these other chain and other protocols too, that seek to kind of price the risk and like evaluate which collaterals they want to accept into the vault. And then from there, the end user can basically select which risk manager or like vault curator that they're comfortable with going with, and they can see transparently on chain what's being allocated to it. In order for them to accept like new collaterals, they have to kind of propose something, and there's like a time lock. So I would think a lot of institutions are closely monitoring that on their positions when new collaterals are kind of added. And the force function of like proper risk management around that is the crypto Twitter will be the first people to tell you when something goes wrong and there's been a certain actor that's allocated to a certain token that something has some kind of vulnerability with it, or there's certain controls that they have that question whether like what's kind of going on behind the scenes in a way. And so that is something that's like strong about crypto, is like it's pretty hard to hide some of these decisions, and it allows like the end user to make decisions for themselves.
Yes, absolutely. And let's say that you are, I mean, not you, but a user might be new to the space. They want to know, well, first, how will they know that a project is sustainable for a start, or that yield is actually sustainable? And second, how can they know about a signal that they should be aware of for risk?
Yeah, for sure. I think there's like definitely like Lindy across the space. So obviously like Uniswap is a known brand who has been around for a while, very battle tested. And this is an example of like an AMM or a decentralized exchange. Same kind of goes for like the money markets and the yield layers like Aave and Morpho. So I think it's pretty hard for like new entrants to come and drive that that trust that is really needed for people to trust you with your protocol. I think there is a part of crypto is like about kind of like signaling a narrative, as you said. So like on Morpho now, there's a Galaxy is a very big fund who curates their own vault, like Apollo and like Morpho. Bitwise, for example, is leading ETF provider. Like now they're using that infrastructure themselves. So you can kind of like trust not only what people are saying, but what the people are actually doing. And if they're kind of using those infrastructure layers, it should show definitely some signal there too. In terms of like overall taking this outside of the lending layer into like chains and all of that, I think time definitely drives a lot of trust too. If you're like a multi-cycle project, for example, like Polygon has been around for like 5 years, is a known brand, trusted, whether it's like every chain is liked and disliked by a lot of people. But I think for like multi-cycle chains, like people that have been around for a while, is like how you build trust, especially in crypto, when there's like this concept of grifting and people kind of coming in for a year trying to scam or whatever else, and then kind of like leaving after. And so I think, spending time with the people and the founders and the team, getting to know what their kind of like vision is, what their plan is for the future, knowing what they've worked on in the past. Like if people have been here for like 5 years, I think you can kind of trust that they're genuinely trying to build like the future of finance. Whereas people that are brand new, kind of in and out, experimenting, they just need to provide like more of a signal that they're kind of here for like the long term.
Yes, it is tricky, right? Because you might have many new founders who are really eager to change the landscape, and it is still difficult because trust, it's still an issue in this space, I think. But at the same time, we have TradFi, right? It is moving closer. Many DeFi projects are now relying on assets like US Treasuries to generate these returns. So do you think that shift, moving DeFi closer to traditional finance, is a potential positive or a negative outcome?
Yeah, I think it was probably inevitable at some point for crypto to kind of like win per se. I think in order to accelerate the adoption and the growth, TradFi is like a needed component. Some people like it, some OGs might not, but that is what's kind of take it to the next level. And I think it kind of starts with stable coins, getting comfortable with the rails before then kind of accelerating to broader DeFi stuff. So yeah, I think it's definitely an interesting kind of convergence with TradFi and with DeFi. In previous cycles, there's been more of like a dislocation or a larger gap between the yields you can earn on chain versus off chain, and that's somewhat representative by the different risk parameters of holding assets off chain versus on chain, and the things that can kind of happen to your assets on chain. On the same time, right now, obviously, we've probably seen like the rates on Aave and on Morpho are actually look lower than they are in treasury bills off chain, which is a pretty interesting dynamic. And so then the question is like, why should I kind of take my funds on chain just to earn like a lower yield for like more risk? There are like structural reasons why it does make sense, even with that, to hold your assets on chain. Having it available 24/7 consistently, being able to get in and out with it on the weekends, being able to arbitrage different yields, being able to take advantage of different opportunities. If your money is like already sitting on chain, it's a lot easier to kind of identify market opportunities, whether it's on like perpetual exchanges like Hyperliquid or any other kind of trading avenues or crypto assets. You can't just kind of have your assets sitting in treasury bills on Saturday night, say, hey, I see this opportunity, I'm going to go capitalize on it. And so even with lower yields, there is still like a structural demand for assets to stay on chain.
Yes, great. And do you think DeFi has actually been transparent enough about how these yields are generated? Or do you think the industry has oversold itself?
Yeah, well, so I would say that I have no idea how my bank is generating yield. Like there's a ton of ways that they're generating yield on that too. On the DeFi front, I think it just depends on like the different market actors. Some are more transparent than others. And as I said, I think over time, the people that are more transparent are like proven right and are able to kind of accelerate to another layer of trust. And then there is like obviously some people that are less transparent, and some of them have reasons for it, and some of them the market doesn't know what the reasons are for it. But like on the reasoning side, there are different strategies, and similar if you're like a liquid fund, you don't want to kind of give up like that edge and show people what strategy that you're kind of like doing at all times. Because one thing that can potentially do for these tokenized hedge fund type of like yield coins that we call, that can kind of dilute your yield if a bunch of people come in and are executing on the same strategies as you without an uptick in borrowing demand and activity from the other side.
So looking into the future, what kind of DeFi models do you think that will actually survive this shift that we've been talking about? And which ones do you think are likely to disappear?
Yeah, so I think distribution is a huge part and kind of king of this. And so the models is definitely really important, and the tech is important, but I would say like you can't kind of forget about the distribution element and the convenience of tapping into fintechs who might just want to tap into your yield. So like at Katana, our goal is to kind of import liquidity from all these other chains and these different fintechs and kind of export yields to them. In terms of like the other models, yeah, I think there are a bunch of different approaches, and I don't think it's like one size fits all. It's just like a risk spectrum where people want to take higher risk for higher rewards. People want to take lower risk for lower yields, and that's just like a healthy kind of like market environment. And so like one way to kind of drive sustainability is not to talk about Katana too much here, but basically the way we kind of do it is the bridged assets from the L1 to the L2 then generate yield on both sides with taking like similar risks. So yeah, happy to dive into that further, but there's like ways to kind of create some sustainable yield through on-chain activity too.
Absolutely. That was actually my next and probably the last question, or at least the last official question. How does Katana fit into this landscape, and the different tensions that we have been talking about?
Yeah, for sure. So one key differentiator with Katana is the USDC that's bridged from Ethereum mainnet to Katana is actually lent out on Morpho on Ethereum L1. All of the yield that is generated on Ethereum L1 is from borrowers paying lenders again, but that yield actually goes to Katana, the foundation. And then we have the ability to then redirect that yield back into DeFi users. So our goal basically is to treat DeFi users as first-class citizens. And the way we kind of do that is we don't treat all users equally. We've always said that we don't. We basically treat the users that actually use the protocols. So if I'm holding USDC on Katana, in the background, that USDC is actually earning yield, but I don't get that yield unless I go participate in DeFi itself. And so it does add like a small like extra layer of risk, but that again is like this whole concept of having like risk adjusted yield. And then when a user goes and deposits on Katana, they get the lending rate that is driven from the L2 activity, plus a portion of the L1 activity that's backing the stablecoin. And so we generated about $600,000 of revenue last month on it, about 3 or 4 million of revenue since launch. And that can all be redirected as a source of sustainable yield. That has nothing to do with token emissions, but has only to do with more dollars, and that's kind of like what people care about. Then we go back to the distribution on the fintechs and all of that.
And how do you see Katana in 5 years, let's say? And what would be your measure of success?
Yeah, for sure. So we're building like a vertically integrated chain and exchange where users can kind of come and unlock utility for different assets. So the idea is you can come, you can lend your assets, you can borrow assets, you can then take those assets after accessing credit and go trade on the spot decks, go trade on the perp decks that we recently acquired, and kind of have like an all-in-one, like holistic experience for users that is kind of has structural incentives that don't only rely on token emissions, but also rely on the real yield that's generated from the backing of the USDC, which is kind of embedded throughout the whole chain. And then we have some other different interesting things that are coming or have been announced. And we have like our own token that basically rewards people that participate in the economy and allows people to stake their token and vote and direct where this kind of liquidity and emissions and real yield actually ends up going.
So how do you see Katana as successful? Let's say Katana really made a success. How will that look in 5 years?
Yeah, for sure. So I think it'll look in two different ways. So one, we have our own application. And so I think like thousands and hundreds of thousands of users are ideally coming to Katana and experiencing this all-in-one unified experience that's kind of driven from this coordination layer. And then the second thing is Katana as like this infrastructure layer where people can integrate Katana in the back end and then also receive yields and like still have their own distribution, their own user experience, and their own users while tapping into kind of like the real yield that Katana brings.
Well, let's hope to see that, and we will definitely keep in touch to, keep track of it. So thank you so much, Matt, and let us know if, anything changes. We'll be keeping an eye on it. Thank you so much for taking part today.
Thank you. I appreciate it.
Thank you. See you later.